Good morning, ladies and gentlemen. Let's very quickly review the price action as it actually occurred last week. Very little to report, very little change in US interest rates. The two-year note was stuck in a very narrow range. Absolutely no difference, 1 basis point difference in yield. The five-year note in terms of yield exactly the same. It has corrected slightly 2 or 3 basis points, but it is now still price yield is above the 200-day moving average, so it's still in a fairly bullish for yield phase and bearish for price. The same can be seen in the 10-year note. In terms of yield, we just cannot break lower. Therefore, at some stage we think we will continue to break higher towards the 190 level. 30-year notes, TLT, much the same. It is still below the moving averages, the short-term moving averages. We don't exclude possibilities of quick bounces towards the 137 area, but that is our shorting area. We think the risk reward at 137 is for lower prices, and then going towards the 127 area, which is very good support. We have the MACD actually crossing higher, so we would not be surprised over the course of the next couple of weeks to see higher prices in TLT. But while we are below 137, we think nothing much has changed, and that the risk reward is still towards selling it when we get towards the 137 area. So we still think that higher yields are eventually likely in the US. How is that reflected in other asset prices? Well, it's reflected in the daily dollar, which has made new highs. The dollar index is now ramping, and as forecast, but it is probably very overbought for the short term, and that can be certainly seen in the weeklies. We are on top of the Bollinger Bands, but we are making very small retracements and then ramping higher again. This is quite a bullish posture. It might take another 2 or 3 weeks to allow these Bollinger Bands to move towards the par level, but we would not be surprised by a move towards par in the next several weeks. Again, that is reflected, as we said last week, in the euro, which is the main component of the DX, or the dollar index. We are very oversold on the stochastics, but we can remain oversold on the daily stochastics for quite a while, and only 3 or 4 days of rallies and consolidation would be enough to move that towards the 50 area, setting up for another sell. So while we are below the 111 area, we still favor a higher dollar, lower euro. The 200-day moving average and the 100-day moving average are about to cross downwards, so we think that we will should trade next week in a 108 to 110, 110.50 trading range, with our favored position is to sell any and all rallies until a close above 111. Basically what the markets are doing is they're anticipating the December central bank meetings. We have the meeting of the Fed and of the ECB. We're anticipating slightly easier policy and a continuation of QE from the ECB, and we're anticipating a rate hike from the Fed. So it does make sense to sell all rallies, certainly for the next 3 or 4 weeks. when we think probably we will come down and test these levels around, let's call it 107, maybe 106, and there probably the move will be exhausted, and we will have fully discounted the December meetings of the Fed and ECB. Now, in terms of equities, we have had some developments, however minor, in the past week. We have a break higher in the Nikkei and possibly in the DAX. In the Nikkei, it's quite clear that we, having closed above these levels around the 17,000, which capped it before, we could have an easy run towards the 18,000 level, which we think probably caps it for the time being. That is another indication that the stronger dollar is actually helping overseas markets, and we have the same thing in stocks, which are at a very, very interesting juncture. The stocks managed to close right on a very critical trend line. We think they may go up towards the 3150 area, which is very, very good resistance, and then spend a couple of weeks consolidating there before trying to bust even higher into year end. We are coming into the part of the year which is probably the best performing part of the year in terms of seasonality for stocks, and it seems to us that the move that we've been anticipating, i.e. higher prices in overseas assets as opposed to US assets, are beginning to make a lot of sense with the strong dollar. The dollar market, on the other hand, is doing very little indeed. This is a daily chart, and we can see that we keep on trading in a very neutral range, just above big support around the 2100, 2110 area. We haven't gone anywhere the past week. We tried the downside, failed, we tried the upside, failed, and we are very much stuck in a 1% trading range where we have been for the past 10 days, which again makes sense to us. This is constructive consolidation in our view for the American market, and it is bullish consolidation for many other markets. Like, this is ILF, which is the Latin American ETF. As you can see, it had a very strong move last week, and it's been having strong moves since the beginning of the year. This to us seems definitely rotation out of overbought markets in the developed world, like the SPY, and into much higher yielding markets in the developed world. This is a very constructive chart. Another constructive chart is, to us, EEM. We have all the moving averages on the weekly basis supporting this market, and it just cannot break through the 36 level that we thought was so important. So the longer it consolidates here, the more the likelihood that it makes a spurt back up towards 40 into year end. Given these bullish setups in emerging markets, it is very unlikely that we have a complete dump in the American markets. So we favor continued range trading in the American market, with any dips down to 2100, 2110 being bought. We have a very good trade setup in terms of risk reward. If we buy it around the 2110 area, any close below 2100 is a very easy stop, and we think that the market goes slowly towards the 2170 to 2180 area, retests those levels, probably fails, and comes back down towards 2140, 2150. So very low volatility environment in the American market, which is actually reflected in the VXX, which is a very good indicator that people are not expecting much movement in the in the American market. This trend is now so established and so strong that it's going to take something quite amazing to shake the market out of it. Any 100, 200 point jump in VXX seems to be a very good short, as do all rallies in the first or second month of the volatility futures. The trend is your friend, and the trend is firmly lower, or certainly it is a range trade between 19 and 11. So anytime the market pops up towards 17, 18, it's a sell with a stop above the 1970 area, and every time it dips below 11, it is a buy for the longer term. This is actually the chart of the index, which is even better. We have a variety of highs which just cannot be broken. This trend line serves very well for capturing any spike in volatility, and that is why we don't think that moves below 2100 in the ES are actually sustainable. Until we bust this trend line to the upside and start closing above 18 and above 19, it is extremely unlikely that ES can sustain moves below 2100. On the other hand, we don't think that this market is ready to start ramping again. The fact that people are moving money out of ES and into emerging markets is going to cap the upside of ES, in our opinion. What is going to change the current position of the American market? Well, one big development could be Apple. Earnings overall are actually coming out better than expected, which is reflected in the acceleration of the positive slope in the Blue Angels. We still think that the 2200 area is going to cap it very nicely, but we could have this dip towards the 2070, 2080 area on very bad Apple earnings. Apple is a huge component in the tech index, and therefore that is a leading index and has been for a long time, but the market is actually anticipating quite low earnings from Apple. So we think it's unlikely that Apple will be a big catalyst to the downside. It is more likely to be a catalyst to the upside if their earnings actually beat the very low bar set by the market. So we still think we are very much stuck between these times 16 and the times 17 Blue Angels, but our risk reward is to buy it, because we think that the risk reward of Apple this week is going to be to the upside. The other market segments are very much stuck within the current ranges. We find it very difficult to see the consumer discretionary sector breaking through its previous highs, and consumer staples certainly aren't going to do it with slightly higher yield environment and a steeper yield curve. That would have to change for this market to move higher. Energy to us is still a mess, regardless of where oil trades. It's going to be very difficult to buy this market with any conviction, given that it's trading at incredible valuations. So we will leave it well alone. Well, here we are. What could take the market higher? Certainly financials, and it's probably a sector that you should pay attention to. If XLF starts ramping, it's not a fade. Healthcare is definitely an avoid for the time being. We're not saying it busts through the 14 times Blue Angel, but what we're saying is that the risk reward of playing this is just not good enough. We would much rather sit below the 14 line to buy it rather than buy it up here and risk a fall back below the 14 level. This is a 50-50 shot and an avoid. Industrials we just don't like here. We think industrials are stuck at best, and at worst they could start coming down towards these levels that we traded before Brexit. So where's all the strength coming from? Well, all the strength is coming from tech. So if Apple actually takes tech higher, which it could easily do next week, we will have our reason for the SPY to move towards the 2170, 2180 area. But again, we don't think that that is sustainable for the longer term, because one sector going higher is certainly not going to be enough to maintain the index at stratospheric valuations. That's why we think you should concentrate your longs in tech, and you should also concentrate on buying emerging markets. Just to be clear, we think that the US market at the moment is a one horse show, and that is tech. If tech were to give up, I think the whole market would give up. The one thing that would slow the fall will be the telecom sector, which we think is getting quite oversold and which we think is attractive. And the other thing would be probably utilities, as there would be a huge flight towards bonds. But that would not be enough to save it. So that is why we are cautious, and we are saying any close below 2100 has to be matched by a breakdown in XLK. To us, XLK is very much the canary in the coal mine as far as the ES is concerned at this point. And here we have XLK. Next week's move could easily take it to test new highs towards 48 and maybe slightly exceed these highs. And that would be our catalyst for SPY to trade again towards the 2160, 70, 80 area. But again, these new highs in XLK are unlikely to be of the order of 5 to 10%. They are likely to be in the region of 1, 2, maybe 3%. That is why we don't think it's sustainable for SPY to break the 2180, 2190 area in a hurry. We think it can certainly bust through the 2140, 2150 area and trade towards 2175, 2185. But we think the highs are going to be very, very difficult for that market to break, for that index to break. Given that we have a one-horse show and that all the strength in the US market seems to be coming from XLK. Given these yields, what are biases for next week? Well, still the Bund BTP spread, it's done nothing wrong. Any dip towards the 120 basis point yield level we want to add to our positions. ES, as we said, there is value in being long 2100, 2110 with a stop on a close below 2100, but we also want to be short above 2180. TLT, we want to sell all short squeezes up to 137 with a stop above, and in the dollar against the euro, 111 is very important. We want to sell all rallies as close as possible to 111, probably by puts, and enjoy the move down towards the 107, 108 area. In the developed markets, stocks and Nikkei look to be much better longs than ES for the time being, benefiting from the stronger dollar. And gold, we don't see any point in big strategic longs until the dollar stabilizes, but we could be close, within 2, 3, 4%. So adding to gold positions below 2160, 1260, 1250 certainly is not going to be wrong in the long term. We might have dips to 1200, 1220, but we think those are very good buys in the longer term. And again, stressing that emerging markets are very, very strong, and therefore it's unlikely that large drops will be sustained in the US market while that is the case. So those are our forecasts for next week. We hope it's going to be slightly more active than the past week, and certainly the highlight will be the Apple earnings, which could have a major impact on XLK and possibly drag the whole market higher with them. Thank you very much indeed, and have a very good week.